I might just tell you a little bit about Infinitas to put some context into or around the comments that I'll be making about investing in international stocks. Infinitas is a portfolio management business. We look after money for high net wealth investors and not-for-profit groups. We were established in 2008. We like to describe ourselves as being common sense, values-based investors. Most of our clients are women, and that tends to shape some of our investment thinking and processes, and causes us to apply a disciplined investment approach around what we do. Chris touched on the fact that the Australian market isn't presenting a lot of value opportunities at the moment, and that's certainly something that we would agree with. In terms of building portfolios for our clients, we don't believe in the idea that a pie chart should be governing your investment decisions. We don't believe that you need a Noah's Ark approach where you have two of everything, and we don't necessarily agree that you need to have a representative selection of stocks that try and replicate what the market composition is. Instead, we take this as our starting point that cash is kind of the default investment for people. You need to be convinced that something is going to be better for your portfolio than continuing to hold cash. So our approach is to look at what in our screened universe of stocks, and certainly we make use of Skaffold to help us with that screening process. What in that universe is going to be better than cash right now? What level of risk does that present to us in constructing a portfolio, and how does that selection of stocks fit with our view of the world? Are these things that we'd like to be investing in at this point in time? Is it the amount of exposure to the market that we'd like to have at this point of time? Are there particular sort of themes running either in our thinking that we would like to be sure of investing in, or are there themes that might be sort of overrepresented in that stock selection? So we if you like, temper the bottom-up stock selection with that top-down, more macro overview of things. On the next slide, we point out that, as we've said, the market here in Australia is not presenting a lot of opportunities at present that we're convinced are better than cash right now. So that's really been a combination of the fact that with sort of a slower economy and with sort of some difficulties in adjustment from the mining boom and sort of a repositioning of the economy, there does appear to be a slow earnings growth profile for most of the companies that we would be looking at investing in. It's also hard to find value in those stocks that do have a better growth profile, because investors have sought out anything that seems to present an attractive, sustainable dividend yield. Also, it's worth noting that probably our view of the outlook for Australia is less favourable at the moment than for some other parts of the world. Australia wasn't as deeply impacted by the GFC as some other economies, major economies, and consequently, now that there is some form of recovery taking place around the world, there's less upside in the Australian economy relative to some of those other economies in a recovery phase. The money printing that's taking place in various economies, it does present a better opportunity for increases in asset prices. And while it's probably less of an issue just now as relative to the position a couple of weeks ago, the Reserve Bank certainly if it had been considering cutting interest rates any further, and it seems like that's now off the table, but it was a little bit constrained by its concerns about the housing and inflation outlooks. Turning now to the Australian market, presents an unusual set of risks. Despite the fact that there's thousands of stocks listed on the Australian Securities Exchange, there is a real lack of diversity in what those companies are, particularly of investment quality. 3 GICS codes, or industry sectors if you like, represent 70% of the 200 index by market capitalisation, and financial stocks are 44% of that index. So in order to sort of get a sensible spread of stocks across different sectors of the economy, you have to question sort of this approach of index investing. I don't know that it makes sense to have 44% of your portfolio invested in financial stocks. But beyond that, the market here does have a high degree of exposure to credit, to China, and to housing. And there's potentially strong correlations across all of these. The reason that credit exposure is so strong is partly because of the financial stocks having such a heavy weight, but also companies here tend to have a high degree of gearing relative to other stocks around the world, and certainly sort of stocks like Microsoft that Chris spoke about. They're in a net cash position rather than having any net debt on their balance sheet. And when you look at the market, there's a real lack of non-commodity global businesses. So if we want exposure to faster growing parts of the world, it's difficult to find in the Australian market good quality stocks trading at decent prices that are going to participate in that aren't just selling commodities offshore. And because of that scarcity, and I use sort of Ramsay Healthcare or CSL as examples, that scarcity sees those stocks trading at significant premiums to what might be sort of a value investor's desired level to buy such stocks. Further on the point of the lack of diversity in the market, I've mentioned that there's high levels of debt in the Australian stocks. There's also a lack of diversity on the board of Australian stocks. One of the factors that we look at, we do seek out wherever we can companies that do demonstrate diversity in their board appointments, in their senior executive levels, and only 9% of the directors of Australian companies are women. Markets like the UK have a much higher level of participation by women on sitting on boards and in senior executive positions. We as a firm think that's important. We think that adds a different perspective to management decisions, and that the quality of those decisions ends up being better with that greater diversity. The market here also has very limited representation in some key and very attractive industries. The sort of industries that we think are going to be significant in the foreseeable future, the sort of industries that we would like to be investing in, things like healthcare, IT, food and agriculture, water markets, the rise of the Asian consumer, clean tech and renewables. While there are some stocks in these sectors in the Australian market, there's not very many, and there's not very many that are of significant size When you look at sort of sectors like clean tech and renewables, there's not very many big companies of investment quality that are in that space. So if you want to get exposure to those sorts of things, which we think is worthwhile, then the alternative is to look offshore to global markets. So in terms of building a portfolio that has diversity in it across sectors, across management, across levels of financing risk, and without having a portfolio that has a very high level of concentration risk, it does require a broader universe of stocks to select from than is available just by a limited selection just here in the local market. Some examples of stocks that we think are of interest on this basis. I put together a list of 3, and as it happened, 2 of the 3 were in the top 5 that Chris identified and that are in that Money Magazine article. So it's an interesting pointer. But if you look at sort of the characteristics of these stocks, Great Wall has exposure to, while it sells vehicles around the world, it is a significant player in that rise of the Asian consumer. So if we want exposure to that theme, then Great Wall is a candidate for investment in that space. Microsoft, really, the Australian market just is so lacking in high quality IT stocks. So Microsoft helps. Consideration of Microsoft helps in that regard. And the third one that I have there is Amgen, which is a healthcare stock. It's an American stock. It has a low level of net debt, dividend paying. That dividend has been rising at a good rate. They've had a good track record of growing their earnings. They've got a high return on equity. You'll be able to look at it yourself on Skaffold. It's in terms of sort of our scoring of the stock as in terms of business quality, we see it as being similar but slightly inferior to CSL, but it's trading at about 7 PE points cheaper than CSL trades at. So while we think CSL is a great business and is going to continue to be a great business, on a valuation basis, Amgen looks like it's certainly worth keeping an eye on. It's probably not at a level where we would go out and buy it straight away, but it's one that's certainly on our radar to keep an eye on.